is Lamarr Baxter. I'm the Business Development Manager for AccuPlan Benefit Services. I'd like to thank everyone for joining this afternoon's webinar. As normal, we usually put on regular webinars such as these as well as live presentations to educate both our existing customer base as well as those who are looking to explore the investment options of a self-directed IRA. Today's topic is going to be covering private real estate lending and investing. So basically what we're going to be talking about today is how to become a private lender using your self-directed funds. With the real estate market heating up, a lot of our clients, as well as those looking to use a self-directed IRA and become a private lender, are exploring the option of further diversifying their investment portfolio, as well as taking maybe a passive approach to real estate investing, because not everyone has the time and or the expertise to invest in real estate directly. So they want to maybe explore the idea of becoming a lender using their retirement funds and use that as a source or an option to grow their retirement portfolio. Just kind of give you an idea in terms of how the format's going to work today. Today's session is going to be in listen-only mode for all attendees. This actual session will be recorded, and within the next business day or next 2 business days, we'll be sending out a playback link for those to be able to play back at their leisure, as well as to be able to pass along to those who weren't able to sign up for today's webinar. We'll have a Q&A session towards the very end of the presentation. I'd like to make sure everyone basically use the chat feature to type in any questions they may have relative to the content that will be covered today, and towards the end we'll answer as many questions that we can. If we are unable to answer all the questions, we'll be happy to answer any questions offline via you making a call to us, sending us an email, or whatever option you have available to you to get your questions out to us. Just kind of give you a background on myself. I have over 23 years of financial experience relative to both real estate, private lending, investing, and running a host of other businesses. So a lot of information, or should I say a lot of my education and past experience really translates over to being able to help my clients be able to make sound decisions in terms of real estate investing or any other type of investments they're looking to use their self-directed plan as that investment vehicle. Our guest speaker today, before we get started, I'm just going to read off our disclaimer, and we'll go into who our guest speaker will be covering. Most of the information we'll be covering on the subject of private lending. Before I get started, because once again, this is for educational purposes only, we do not provide any investment advice, tax, or legal advice, nor do we steer anyone towards any particular investment. Our objective is to really just to let the audience know what options you have available to you and what a lot of our clients are seeking information on. So usually based on demand of a particular topic, we usually try to procure a speaker to come and speak to our audience on different areas of investment using a self-directed plan. So with that being said, I'm going to go ahead and read off our disclaimer. AccuPlan Benefit Services and its affiliates do not provide investment advice or endorse any products. All information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. So with that being said, I'm just going to talk about our guest speaker here. We're going to have an organization by the name of Red Tower Capital. The speaker will be Mr. Solomon Gorelick. And I'll go ahead and let Solomon kind of give you a background on what he's done over the past few years in terms of real estate investing and how he is going to be the expert today in talking about how private lending works and how self-directed plans could be an excellent vehicle for you to use to be able to invest in real estate and take that passive approach. So without further ado, I'm going to go ahead and pass this along to Mr. Gorelick. Just give us a few seconds here, and I'll go ahead and pass over the screen options over to him so he can go ahead and share his PowerPoint with you. Okay, Solomon, you should be ready to go.
Great. Thank you very much, Lamarr, and thank you, everyone, for the opportunity to speak with you today. As Lamarr explained, I work for a company called Red Tower Capital, and we're based here in San Francisco, and we focus on private real estate lending and investments in real estate, mostly locally in the San Francisco Bay Area. This is what we're going to try to cover today, and I certainly encourage any questions. As Lamarr explained, we try to tailor this to what we thought folks might be interested in, but certainly happy to answer any questions or further develop a response to what you guys might be interested in. So anyway, we're going to discuss private real estate lending, our investment process to give you some idea of of how we think people should underwrite loans, individual investors or other folks in the industry or other private lenders. Some examples of the types of loans that we've done involving some of our funds and some of other investor funds, what private real estate lending is all about, and briefly describing one of our offerings that we make available to the public. And just a little bit more on us. We're, again, a private real estate investment firm dealing with private lending here in Northern California. We primarily do these private real estate loans, but we also do preferred equity and joint venture financing, again, all on local real estate for the most part. We also have, for investors' point of view, we offer pooled mortgage funds, and for larger investors, separate individual accounts, which is basically where we invest their funds in a collection of loans as well. RTC, or Red Tower Capital, is owned by the three of us, Danny, Ken, and I, and together we have over 40 years of real estate experience in overlapping and similar but different kind of ways. I won't sort of beat it up too much, but I've done a lot of private lending and also investments in real estate development, and Ken's done a lot of private lending and other type of mortgage and substantial development as well. And Danny's also has a lot of experience in other types of acquisition and development. You can see there where we studied and things like that. But part of the key area, just to focus on for a minute, is that we just have a lot of experience here in the San Francisco Bay Area. Obviously, understanding markets is key for any lender or investor in real estate, whether it's in this area or some other part of the country, in my opinion. Okay, so what is private real estate lending? Basically, it's of course lending, it's of course real estate lending, and it's essentially non-bank lending. So Red Tower Capital and our competitors, or certainly individual investors, can potentially be lenders, and obviously we're all not banks. Banks are obviously especially regulated entities. We can make loans, or any of these private lenders can make loans for purchases, refinances, and we also do for construction or rehab, and certainly individual investors can do that as well. Obviously, in order to compete with a bank, we have to have some kind of different underwriting standards. Of course, we'll speak more about that. Why are they coming to us versus the bank? Or if you're doing your own loans, why are they coming to you versus the bank? In this market, the rates are approximately 8 to 12%, really depending on the risk and the desires of the investor and the borrowers. We'll get more into some examples. We think these types of loans, if they're done right, offer predictable and solid returns. And of course, if you do your documentation properly, obviously you get real estate type security with asset-backed protection, which is a little bit different than some other types of investment, which we'll talk a little bit more about. So from a borrower's point of view, why would they go and use a private lender? And these are typically the reasons, having done this for some time. Borrower needs or wants a quick close. For some reason, they might have thought they can get a bank loan and that failed, but they still want to go forward on the purchase. They might need the funds only for a short period of time, so paying a higher interest rate for a shorter period versus a bank loan might be a good trade-off for them, particularly if a bank loan is hard to get, as it often is, or takes a long time in this market. Of course, another example is they have weak credit or weak income documentation compared to a bank's requirements. If, for example, they have judgments or late payments, tax liens, or bankruptcies, something like that, then obviously that disqualifies from most bank loans. And then, of course, separate apart from the borrower, the property itself might require a private loan. If the property is damaged and needs work, or if it's supposed to be an income property and doesn't have substantial income to support the loan, or if it's just some unusual type of property, vacant land in this market would be hard to get a bank loan on, for example, as well. So here we're just describing, some of the differences between bank underwriting and private lending, particularly in this market. And of course, a few years ago, the banks in general were more relaxed in their lending, as I probably don't need to explain to anyone. In this market, they're relatively tight, and who knows, in 3-5 years, obviously, the market can be somewhat different. But in general, this applies, and certainly in this case, we think this applies. So obviously, bank lending, the regulation is very high. Private lending, we are regulated, and even individual investors are theoretically regulated, but the regulation is much lower. Obviously, I can answer specific questions about that if you like. Time to close, generally speaking, a bank loan takes longer than, of course, potentially a private loan. Typically, a borrower needs strong credit and income. and a private lender might accept weak credit or weak income in certain cases, obviously, also. In the general sense, a bank loan that's on an income property needs strong current income and generally pretty good condition. And again, we can you know, deal with some of those types of issues with the private loan. And a lot of the bank loans need to meet agency requirements, because almost everything that's a single family to a 4-unit loan, a 4-unit property today, that's made by anyone in California or most of the country, 90+% of those loans are being sold or insured by the government, as probably most of you know. So really, that's the FHA, Fannie and Freddie, and there's a couple other smaller agencies too. These, essentially, Bank of America or similar needs to make thousands of these loans, and they have to meet strict criteria. So there's really less room for flexibility. Obviously, from our point of view, we try to just look for, or individual investors to try to make sense loans, and we don't necessarily have to fit a certain criteria as closely. So the bottom line here is light regulation and quick close time allows for flexibility and much more, many more lending opportunities. And this is just a little bit more on the current conditions create a special market. We just described 90% of the loans are Fannie, Freddie, FHA, and for those interested in the alphabet soup, there's also VA and USDA loans, believe it or not, that also relate to that 90+%. Obviously, this is just an incredible opportunity in general. It's been this way for a couple years, 3-4 years approximately, and it'll probably exist in a special opportunity, even though the rates are changing for a few years to come. And obviously, private real estate lending is highly collateralized and offers stable, predictable returns if you do your job right. And Red Tower Capital is obviously a company that can do that. Here we're just describing again the benefits of private lending. It's underserved market, relatively speaking, can be lower risk than other investments. Obviously, generally speaking, provides current income because borrowers typically pay monthly on loans. We've already discussed security. Of course, there are risks associated with private lending or any kind of lending, whether individually or in mortgage pools, and certainly with the real estate in general. But in case of a loan, a borrower default or bankruptcy certainly can throw a wrench into the works. And if you have specific questions about that, I can answer that. We've dealt with those situations before. Of course, if the values of properties decline, that can impair the security. And of course, real estate has its own risks that relate to lending to some degree, tax and legal changes, and of course, changes in the interest rate environment. And from our point of view, we think ourselves or other individual investors can mitigate a lot of these risks by having certain strategies and underwriting criteria and really managing the loans by servicing them well. That just means it's actually collecting payments and dealing with issues related to problems with the loans, if there are any. So here I describe a little bit about our investment process, and again, everybody can have their own a little bit, and it just describes how we think we're different. And I think everybody, whether they're investing with somebody else or investing for their own account, directly making loans, they should have some philosophy, and we have one, and it changes a little bit with time in terms of our strategy. So here, with the first segment of it, our strategize, we define and regularly redefine the basic loan criteria. So as the market changes, if we think it's better to make land loans for whatever reason, maybe because nobody else is making land loans, and the price of land is relatively low, so we think that the risk is relatively low, we might consider increasing the percentage of land loans or volume of loans that are in land in our portfolio. Target loans that are competitive in a changing marketplace. So for example, up until about a year ago, although we're still doing it, we really focused a lot on flipper loans. We still do those where folks are buying a property and flipping that property after doing some light rehab or maybe even heavy rehab. So of course borrowers are still doing that these days, but particularly up until a few months ago, we thought that was a really competitive place to be, and we could charge a premium for providing that type of lending. And in fact, in some of our mortgage pools, we actually lended higher than the loan-to-value, as we're going to talk about shortly, but in exchange for a relatively larger piece of the upside on a deal. So everybody has their own strategy. You can go for a lower risk, a little bit higher risk, or higher perceived risk, and you may or may not benefit by doing something like that. Of course, we have, from our point of view, an origination network that, as we've been doing this for many years, we have lots of borrowers and brokers and real estate agents who know us, and then we have a good reputation for being responsive and efficient. which I think is great for obviously for us and our investors. And of course, if somebody's making loans by themselves, they need to have some kind of something similar. We have certain strict underwriting criteria, and we do all these certain things which I can get into a little bit more, but obviously we do title and property valuations and pull credit and things like that, but it really depends on the specific situation and our how strongly we believe in the risk associated with what we're doing. And then, of course, we make a decision. There's three of us that, again, Danny, Ken, and I, we all review each loan prior to committing and prior to funding. So sometimes it's kind of funny. Sometimes one of us might be really promoting a loan, or maybe two of us are, let's say, but we generally want to have the buy-in of all three of us. We all have a different perspective, so we think sometimes that helps and probably saved us a couple of little hiccups along the way. We've been doing this a long time, so we think because of that and the local knowledge and specific markets, it really helps us basically get more and higher quality deals. And again, thinking about this from an individual investor's point of view, of course, they can invest with somebody else like ourselves, but obviously if they're motivated in this way, they should try to focus on a few markets, particularly the higher risk they're sort of looking at taking in a potential loan. There's just nothing that competes with understanding the actual market and knowing the players and the prices and which corners or which cities are better in their opinion to invest in. Red Tower Capital, in the past couple of years, it's a little bit over that. We used to have a few other companies that we worked for. For example, I used to run Red Tower Funding by myself, so don't want to give you the wrong idea. We've been doing this a long time. But Red Tower Capital, with the three of us working together, is just about 2 years old. And so since then, these numbers are a little bit outdated. We've done over 145. It's actually probably a dozen more than that. Transactions. Most of them are private loans. Like I said, we do a few other things. And then we placed about $50 million of capital since in the past 2 years. And here it describes some of those items. And again, we do other things like we buy discounted notes. Typically, those are in bankruptcy. Some of those go into our various funds. And then occasionally we buy rehab opportunities or other opportunities ourselves. So we're familiar. I mentioned those things in brief because one is being familiar with lending, but by having some of these other sort of experiences in rehab and development, we think that also feeds back with us being able to find and underwrite good loans. And certainly if something goes wrong, it helps us to potentially be in a better position to resolve that type of problem. Current loan portfolio, again, this is about 30 days old. I'm actually seeing my little footnote there. It's just over a month old. But anyway, we have the bulk of it is single-family homes today. Actually, in the past month or so, we've actually put out a couple of land loans, and we have another one that we're ready to fund. So although it says 1% on land, we're actually a little bit higher on that now. We certainly love multifamily, commercial, and, in my opinion, land in this market. It's just that a lot of our good and easy and fast loans have been houses, and that'll change with time. We make a lot of loans locally, a lot of small loans, a lot of REO purchases and short sale purchase loans where we're lending to somebody who's buying a property from a bank or that's sort of underwater, so they're buying it for less than the existing loan balance. And like I said, we're focused primarily in the Bay Area. A lot of our loans are in the East Bay, quite a few in San Francisco, and we just closed one in Philadelphia, it turns out, because we have one of our existing borrowers who wanted to buy something out there that we thought was a great deal, and so we just did a land loan in Philadelphia, Pennsylvania, believe it or not. So that's one of the few that we've done out of state in some time. Typical underwriting standards, again, every deal is different, but almost all of the loans that we're making are first position loans. I can go into that a little bit later if you're interested in the Q&A. Obviously, first versus second, inherently safer for a bunch of different reasons. Most of our loans have 60% or lower loan to value, but we do go higher on particularly on purchases or some of these value add opportunities. New purchases will go up to 70%. We're charging anywhere from 8 to 12%, and actually occasionally, usually it's not 8 or 9, it's usually 10 to 12, and occasionally we'll do 13% loans on one of our land loans just recently, for example. We'll make really small loans of $50,000, and we'll make loans out to $2 million. and usually the terms are underneath 2 years, and almost everything's in Northern California again. And like I said, we'll lend on any property theoretically. Loan to value, you guys are probably very familiar with this. It's just a ratio of the amount of the loan amount to the actual property value. And of course, a higher loan amount to a property value, generally speaking, means a higher risk. But of course, the flip side with that is good borrowers can probably, generally speaking, justify higher loan to values or good properties or good projects. Anyway, so here's just a quick example. Obviously, $250,000 loan value in a property value of $495. Excuse me, it's just a hair over 50% loan to value. And you can do your own math on some of these other ones. This relates to a loan that we did for 12% for a term of 1 year previously. Now, just a few examples. Like I said, we lend on all types of properties. Here's a loan we funded a few months ago that was $770,000, an Oakland house, a very large, beautiful home, or it used to be beautiful, that they're basically trying to convert to 14 residential units. So this could be just as a quick example of, the bank wasn't, the borrower went to the bank with this. The bank, multiple different banks, they liked the property in some sense, but they weren't excited about the business plan of converting it into 14 units. It was vacant. It was questionable if it could be converted from the bank's point of view. They didn't want to take that entitlement risk, they thought. So a really good borrower came to us, and we agreed to fund their loan at 70% of their purchase price and charge them 11.25%. So again, nice location in Oakland, great property, relatively good borrower. Why is it a private loan? Banks were worried about the business plan or the entitlement risk of the property. Here is another example of a nice property in San Francisco. We actually lent on 2 units of the 6 units in San Francisco that are quote-unquote tenants in common, basically partial investment interest or ownership interest in the building. Something that's pretty common in San Francisco, but only a couple banks do it. So if the borrower can't qualify at those 2 or 3 banks, there's really almost no market for this type of loan. So if you're familiar with the notion, you like to have this type of security, you don't mind special lending documents, this is a great small market, but a niche market for private lenders like us, or of course also individual investors. This is a flagship property. I can mention it now because we're not in the loan anymore. If anybody's been out to Napa, I'm sure many of you have, but this is a particularly nice property, a retail property called the Oxbow Market. There we actually funded a second position loan. Our security was a leasehold security, not an ownership or fee security, or really the borrower's interest was not a fee ownership, it was a leased ownership. So it had a couple of extra wrinkles. We're second position, great property that generally speaking is very bankable, and a pretty good borrower. And the basic story is the borrower was getting a discount for purchasing the loan from the bank in a hurry. So we funded the bulk of that discount, and I can answer more questions about that. And we charged them, frankly, it says they're 7%, but the total return was about 20%. Basically, we had a 7%, current rate, and then we were basically making a big exit fee when they refinanced us with the bank loan several months later. So that was a great loan and on a great property, and a neat example of what we can do as private lenders. Here's just a small, similar to many of the properties we might lend on, REO purchase loan, 2-year term, 12% rate in the city of Richmond. And here is a simple land example. Again, we like to lend on land in general in this market. We don't do a lot of it because the prices are relatively low, and we think the long-term risk is small. A small commercial property. I'm just going to go through these to try to give us a little more time with questions. And here I just do just describing some of the basic high-level differences between mortgage funds or even mortgage loans and rental properties and deed of trust investing. I won't belabor each item here, but the basic idea with rental property, which we kind of believe in, you own the property, you have a high potential return if you get in at the right time and have good debt and good management. Of course, you get monthly income generally from your tenants. You can choose your own investment. The downside of that is, of course, tenants might not pay. The property can go down. you have to manage the property or hire somebody for 5 to 10% of the gross rents. Obviously, it can take a lot of time, particularly if you're managing it. And if you don't sort of time the markets well or focus on that, managing that, of course, you could have risk, execution risk, we call it. Anyway, and of course, if your debt is not fixed or if the prices go up or down, of course, you can have a substantial problem with the existing debt on the property. Individual deeds of trust have a great potential return. Obviously, I believe in them. I've been doing this for some time, and I have investments like that myself. Assuming the borrower pays, you have great monthly income off of those loans. You can choose your own investments. If you want to invest in this deed of trust or that one, you obviously own the deed of trust. If you own it by yourself or half of it, you can sell your investment interest. And the investment is debt. It's not risky or equity, obviously. Of course, the borrower could default. The property could go down. You have to service the loan, which generally speaking is not that much trouble unless there is some problem. And then your capital is invested in the loan, for good or for bad, passively until the borrower pays you back or something else happens. Mortgage funds, we think, is, of course, part of what we're here to talk about. And we think in a general sense they have a lot of benefits for the right investor. Of course, a mortgage fund is a collection of individual deeds of trust, and so it allows somebody to diversify across multiple deeds of trust. If some borrowers aren't paying for some reason, presumably the other ones are. So it certainly smooths out returns. An investor, if they chose to do mortgage funds with us or somebody else, obviously doesn't have to underwrite each individual loan, which is the potential risk, particularly to people who haven't dealt with individual trust deeds before, of underwriting every loan and trying to make sure they're not being sold something that's too risky or something else is otherwise wrong with the title on the property or something like that. Obviously, mortgage funds are debt, not equity in the same sense of a trust deed. We think it has a lower risk of borrower default mortgage fund because, generally speaking, there's one, the diversity across a bunch of loans, and then two, typically they're professionally managed. And then, of course, but you could have risk anyway. And then, of course, the possibility of value decline is always a potential problem, but hopefully that's dealt with smart management. But that's always a possibility. So we think in general mortgage funds offer lower risk than deeds of trust investing and most rental property investing for most people without a significantly lower return. And here's a little bit more on the mortgage fund advantage, but we described that a bit there. Diversification, simplicity, again, you don't have to underwrite each loan, pretty convenient. You can get in and out loans after the lockout period or in and out of our fund, for example, and other funds after typical small lockout periods, which is a little harder on a piece of real estate or an individual deed of trust. And of course, they generally pay on a current basis. Our mortgage fund, for example, pays every quarter, which we think is a nice way to smooth out the returns. This is one way of looking at anticipated risk and expected monthly income for a bunch of different types of investments. Obviously, we have our own opinion on real estate and mortgage funds. But of course, savings accounts, CDs, there's almost no risk. But of course, there's almost no yield today. Don't need to remind anyone of that. Mortgage funds and stocks, everybody will have their own idea. But basically speaking, a stock is equity type risk instead of debt type risk. Of course, if you are in Apple at the right time, you make a lot of money. If you're in Apple at the wrong time, you can lose money, of course. The same is, of course, true with mortgage funds and rental property. But generally speaking, the debt has relatively modest changes in its yield. Here we're just comparing long-running averages of multiple investment types historically. And if you had, our mortgage fund, for example, RTC2, Retail Capital 2, is already yielding, is projected to yield approximately 7.5%. Annualized, again, paid quarterly. So if you compounded that, and RTC2, by the way, is new, so we can only look back. Actually, there's only been one. Our first distribution was the first quarter of the year, and we're doing the second one now. But anyway, actually, both yields are over that. The first was 9.35, and the second one that we're distributing now will be approximately 7.5. But in any case, obviously, stocks, bonds, and CDs have different rate characteristics, and looking back 10 years, this is what the stocks have done. The CD rates, 10 years, are approximately 2.2%. Obviously, it's much lower than that today. And bonds, based on the average we quoted below in the footnotes, is about 5%. I won't beat this one up, but you can take a look at this one later, hopefully. And just comparing, again, the anticipated return, risk, security of a bunch of types of investments. Again, everybody will have their own idea about this, but we've given you our opinion on how mortgage funds fit into that. And in brief, although we're not the only game in town, we offer Red Tower Capital II today, which is a pooled mortgage fund with a maximum fund amount of $25 million and a minimum investment of $25,000, and then we also do individual separate accounts for larger individual investors. Almost everything we do for RTC2 is a California first position loan, and we're looking for 7 to 8% targeted yield net to investors. We distribute everything quarterly. Of course, we can take individual investors or obviously self-directed IRAs. And again, we describe the benefits of diversification and items like that. And then I just wanted to briefly explain sort of the economics of the fund. We try to make this available to a lot of potential interested investors. So that's part of how we ended up with the $25,000 minimum investment amount. But one of the key strategies in how we wanted to structure that fund was really to align our interests, or a lot of our interests, with that of our investors. So, the first example of that is when the rates go up, we want investors to be able to take advantage of that. When the rates we can charge, I should say, when the rates that we can charge safely go up, we want investors to get the benefit of that. And when the rates that we think we can safely charge go down, which is actually happening in this market compared to 2 years ago, in my opinion, we want to be able to lower the rates so we don't have to take excessive risk, so that investors, are not duped into having a great return today, but a dangerous situation tomorrow or 2 years later, let's say. So the way we've set up RTC2 is that we have a servicing fee, or we call it asset management fee, which in a theoretical problem allows us to keep the lights on. And then the next is paid 6% to the investors, and then everything in between those two numbers is split 50-50. And we throw in what we call the extension fees, and or the back-end fees, the extension fees, the default interest, the late fees, all of those items. So the bottom line is, if 5 years from now we can charge 15 or 20%, which I'm not really expecting, but I'll just suggest that for a minute, the rate that an investor will get will go substantially up. At the same point, if the rate that we can safely charge drops to, for example, 9% on average for our loans, we'll drop the net yield to the investor, but at the same time we think we're making safe loans for them, which we think will benefit them compared to other investments they might have in general. In separate accounts, we can do different types of structures, but typically, basically, the investor will determine that a little bit with our guidance. It might include defaulted loans and maybe some rehab type stuff, and maybe more seconds versus firsts. So we can structure things of that nature for the right type of investors that are interested in that kind of thing. And we usually align the interest in some similar fashion. So in brief summary, private lending is an underserved market with rewarding opportunities, particularly today, because again, the banks are throwing everything into 3 or 4 boxes, which means there's a lot of room for the rest of us, whether private lending companies like us or individual investors. Certainly something like this can be used for individual or investing with individual investor money, or obviously self-directed IRAs are great for this, relatively passive type investment. Stable returns and steady income with relatively little to do. And if you're interested in learning anything else, obviously you can come speak with us. You can call us. Our contact information is there. You can visit our website. And certainly happy to answer any questions that you guys can pose now or later. And here's just our little bios again, Danny, Ken, and I. And that's it.
Great information, Solomon. I hope everyone got a lot of information out of it. I really like the comparison that you had showed in relative to some of your traditional investments compared to alternative investments such as private lending, investing in deeds of trust. I know a lot of my clients are really looking for an alternative, and once again, I promote diversification when it comes to your investment portfolio, retirement portfolio, and what you've conveyed in today's presentation really outline the importance of diversification, and also making sure that you're comparing on an ongoing basis all of your investments and more or less look at what's happening today versus what may be happening 6 months to a year down the road, and where you whether you may need to make some adjustments in your investments held in your portfolio. As I mentioned earlier, we're going to hold the Q&A session until the very last portion of the presentation. I'm just going to really cover a summary of the self-directed IRA and some of the rules that you must follow when it comes to a self-directed plan, talking about some of the other investment options, and also showing you how to use the self-directed plan to make an investment into private notes or deeds of trust and whatnot. So what I'm going to go ahead and do now is going to change this back over to my PowerPoint here, and we'll go ahead and get started. For those who joined us late, as I mentioned earlier, that we're recording this presentation towards, I'd say, within the next 24 to 48 hours. I'll be sending out a link, a playback link for you to play back at your leisure, as well as to go ahead and forward along to others who were not able to attend the presentation. In addition, for those who joined the presentation late, just our disclaimer again: we do not provide any investment advice nor legal or tax advice. It's really important that you contact your professionals in these areas to get consultation and advisement on any investment that you're considering. Once again, our objective is to provide education and really to open your eyes in terms of some of the investment options that you have available using the self-directed plan. Once again, a quick summary on AccuPlan, which is our company. AccuPlan Benefit Services. Our parent company is American Estate and Trust. We're based out of Salt Lake City, Utah. Our parent company is American Estate and Trust, based out of Las Vegas, Nevada. We provide self-directed 401k administration products, services, and to individuals looking to invest their retirement accounts into non-traditional investments. We pride ourselves in our expertise on the area of self-directed retirement plans, which also consist of 401ks. We have a very hefty staff consisting of those with tax experience, legal, IRA, and 401k setup and administration. So we have a well-staffed organization when it comes to an expertise when it comes to self-directed plans. One of the things I like to cover as to why most are considering the self-directed plan is talked about some of the statistics as to why people are being steered towards two alternative investments using the self-directed plan. It's estimated that 10,000 baby boomers per day will turn 65 for the next 20 years. And of that segment of the population, they say up to 75% of that population is not in a position to retire at the age of 65 and beyond. So it's something that you really want to take a look at and ask yourself, are you really growing your retirement at a pace that's going to sustain you through your retirement years? It mentions that also most will be forced to continue beyond the age of 65, and that's provided that depending on your occupation, that you have the ability or your employer will allow you to continue service beyond the age of 65. Retirees will face skyrocketing health care costs and diminished Social Security benefits. So a lot of those benefits that maybe 2 to 3 generations ago had the access or the benefit of having at their disposal at their retirement age may not be there for us. So it's really important to once again take a proactive approach in terms of growing your retirement account, looking at both traditional and alternative investment options, and making sure that on an ongoing basis that you're doing the best and receiving the highest yield, and also taking the safest approach to growing your retirement account. Inflation and cost of living increases will threaten to erode their fixed retirement income. So something you definitely want to look at, in addition to any fees that you may be paying on investments that you hold in your investment portfolios, also subtract out that cost of living, the inflation cost, the inflation is going to be projected over the next 10 or 15 years. Say over $4.7 trillion in combined IRA funds and 401k funds. Out of those, both the $4.7 trillion for both IRA and 401k funds, only 1% is invested in self-directed plans or alternative investments. Just to give you some other additional numbers, if you're looking to retire, depending on which portion of the country that you live in, you need to basically make sure you have a socked away at least $750,000 to $1 million is what's really going to be required to sustain just even the basic standard of living. I know here on the West Coast and some of your major metropolitan cities, the $750,000 to $1 million is more or less a realistic number that you're going to really have to consider as it relates to a realistic number as to whether you're going to have enough in your retirement account. So make sure you pay attention and sit down with your financial and tax advisors and look at that number, make some plans and some projections as to where you want to be when it comes to retirement age, and look at some of the investment options that's available to you. They say up to 90% of the population is unaware that a self-directed IRA exists. I know that that 90% also consists of attorneys and accountants, And to all due respect to those accountants and attorneys that do not know the self-directed IRA exists, not every attorney and or CP or tax professional specialize in that area of the tax code. The self-directed IRA has actually been around since 1974 as part of the ERISA Act that was passed by Congress. As of 1975, the first self-directed plan was actually open, and for those who were basically privileged to this information by either their tax advisors or financial advisors, they were basically introduced to this investment option. So not everyone had taken significant losses in 2008 because a lot of those retirement funds were in self-directed plans if you were privy to that information at the time. As I mentioned, your financial planners are trained in this aspect of the tax code. So once again, you go to some of your traditional custodians such as your Charles Schwab's, Franklin Templeton's, they're going to steer you towards a particular set of investments. A lot of times, once I say traditional investments, your stocks, your bonds, CDs, annuities, so on and so forth. And they may tell you that you have a self-directed IRA, but the definition of a truly self-directed IRA is that your only limitations is that you're restricted from investing in life insurance and collectibles. So it's really important that when you're listening to that term self-directed IRA or self-directed is to make sure you understand what your limitations are when it comes to investments, depending on which custodian that you choose. So diversification, as I mentioned earlier, is very important that you basically on an ongoing basis making sure that your funds are invested in the best investment vehicle possible. The majority of those funds, as I mentioned earlier, invested in mutual funds and with brokerage firms. Once again, less than 1% invested in alternative investment assets. So we definitely need to get that number up if most of us are looking to hit that goal of $750,000 to $1 million as far as retirement funds. It's not an unrealistic number. It's based on a lot of investment and some, I would say, safe investment options out there using the self-directed plan. Our motto in the self-directed IRA industry is invest in what you know and understand. I like to believe that everyone has a gift or talent in some area of different investment vehicles that they can basically bring to the table and probably do a better job than maybe their planner or advisor in terms of growing a portion or a segment of their retirement plan. So once again, really think outside the box and look at what's available to you using this plan. Because once again, I mean, who knows what's going to happen down the road? Congress is making a lot of adjustments. And as it relates to retirement when it comes to contributions and whatnot. So we want to make sure that before any adjustments are made down the road, that we can grow our retirement accounts as quickly and safely as possible. I would say real estate is the #1 asset class and has been, I would say, for the last 5 to 8 years that I've been in the industry. And real estate consisting of investing in single-family residence, multi-family residence, commercial, land, you name it, including international real estate. You have the option to invest in real estate in foreign countries, provided that the rules, or should I say the laws in those countries, do not conflict with IRS Code 4975 here in the U.S. Precious metals was pretty hot up into 2010. There's some fluctuations in that investment, right, at least in that investment arena. So once again, you want to make sure you do your due diligence on any investment option you choose and kind of get a history on that investment, as well as what the projections may be in the near future. Private notes and loans, we just covered that with Red Tower Capital. I would say that is one of the most sought out investment options right now, because once again, not everyone wants to take an active role in terms of real estate investing, but they want to be invested in real estate. And I myself, you know, since 2008, I'm an actual private lender based on my background, when I'm actually loaning money out of my self-directed IRA and have been charging up to 12 to 14%. Some would say, well, why are you able to charge more? Mine are more or less a hard money loan opposed to maybe just your private loans. But once again, just kind of give you an idea that you do have the option to charge higher rates, and it's usually based upon the actual deal and the demand for the funds and whatever your audience may be in terms of the relationship that you build with that borrower or borrowers as it relates to the funds you're going to be loaning out. Private companies, that's something that's beginning to pick up steam as well. I know I work with some franchise brokers that are assisting people opening franchises. So whether you're opening a franchise or any business, you have the option to invest directly or indirectly into a business. I know since 2008, a lot of businesses have been around for many, many years, but are starved for capital because the banks have basically pulled back lending, and that also includes credit lines that a lot of these small and medium-sized businesses have depended upon in terms of funding ongoing operating costs and paying payrolls. So there's investors with self-directed plans that are seeking out these small and medium-sized businesses to form some type of investment relationship, whether it be directly investing in a business, granting them a credit line, and using whether it be secured or unsecured sources for those types of investments. So as I mentioned earlier, you invest in what you know and understand, but these are, once again, some of your investment options, some of the investment options I've seen over the few years that I've been in the business that are occurring, I would say, nationwide. I mean, I'm sure if you look at this list here and were to contact your traditional custodian and ask them, could you use your current retirement plan to make these types of investments, I'm sure the answer would be no. Once again, the only restrictions you have with the self-directed plan, a truly self-directed plan, would be life insurance and collectibles. So one of the areas that was really important that we cover is what the do's and don'ts are when it comes to investing with the self-directed plan. And that basically brings us to IRS Code 4975, which basically covers prohibited transactions. And what it basically states is that in any transaction that you're engaged in, you have certain rules as it relates to an arm's length transaction, meaning that there's no self-dealing with yourself and other disqualified parties. And we'll cover that in the next slide in terms of who's a disqualified party and who you're not allowed to make investments with. So basically what it's saying in summary, an IRA cannot engage in any transaction, direct or indirect, with anybody or anything considered related to the IRA. So these are some of the examples that are considered prohibited if you're basically working with a quote-unquote disqualified party, selling or exchanging or leasing property, lending money or extending credit, furnishing goods, services, and a facility. So one of the questions that comes up on a regular basis for those who are looking to invest in real estate, in particular rental properties, is can I, at any given time, live in that property, my spouse or certain other disqualified parties, during the time that my IRA owns that property? And the answer is no. So it's really important that you understand that before you take on the decision to invest in that property. However, one of the options that's available to you, if you're looking to purchase this property, say over the next 5 or 10 years, and you're looking to maybe move into the property at retirement age beyond 59 and a half, you have the option to transfer that property out of the IRA into your name personally, which at that point in time, that transaction will be treated as a distribution. Whatever the property value, the fair market value of that property is at that time, you will be taxed at ordinary income and pay the taxes on that. But at that point, the property is now owned by you directly, and you can live in the property. And if you've done everything correctly or properly, hopefully that property has been paid off, it's owned free and clear. The only thing you're subject to at retirement is paying the property taxes, because hopefully in this case here that you didn't take out any leverage, and if you did, it's been paid off prior to you moving into it and going into retirement years. So one of the two key points is when it comes to IRS Code 4975 is no self-dealing, and no personal use. And that also would tie into borrowing and loaning money out of your self-directed IRA, which takes us to the next slide in terms of disqualified parties, in terms of who you can and cannot lend to. So examples of disqualified persons would be you, your spouse, lineal ascendants and their spouses, lineal descendants and their spouses, any fiduciary to the IRA, anyone providing services to your IRA. And this last one is corporations, partnerships, trusts, and estates which you own directly or indirectly at least 50% ownership stake. So what that basically is saying is that if you have an existing business and you want to loan money to that business, you are restricted from lending money to that organization as long as you and your spouse or any other disqualified parties combined have a 50% ownership stake or more in that business. Now, if you're below that 50% ownership stake, then you have the ability to make loans to that organization, provided, once again, that you are not the sole decision maker. So if there's an event where you want to loan money to the business, you want to make sure that another principal within that business who's not a disqualified party signs off on the loan or any documents that's requiring the transaction to be executed, and not you yourself or any other disqualified party. So in essence, or in summary, you want to make sure that you do follow the rules, don't mess with the IRS. I've actually seen situations over the last 5 years where clients have basically tried to walk that gray area as well as cross that line and actually been penalized, and where what the penalty is total disqualification of the retirement plan, including taxation. If the prohibited transaction occurs prior to the age of 59 and a half, you're going to be subject to an early distribution penalty of 10%. So you look at 10% taxation in addition to the ordinary income tax pretty much will wipe out your retirement account. So it's really important that you understand those rules. Consult with myself as well as your tax professional on any transaction that you're looking to embark upon to make sure that you are following the rules. So the next topic we're going to talk about, how do you fund the IRA? How do you get funds into the self-directed plan to make the investment? So the first one would be the transfer, the method of transferring funds from an existing IRA, say your existing IRAs with Charles Schwab or Franklin Templeton. That transfer process usually takes 7 to 10 business days from the date that they receive the request from us as the new custodian requesting for those funds to be transferred over. But of course, the first step is to open your account. To get the account open, which you'll be assigned a legal IRA vesting, which that custodian is going to be required to see before they transfer the funds over. And that is important because it's important that once those funds are transferred over, you do not want a taxable event. And the safest way to ensure that that you're not basically going to generate a taxable event is to not take possession of the funds. And usually with the transfer, the funds are transferred directly from the existing custodian over to us, which is not a taxable event. A rollover is the method of moving funds over from a 401k or an employer-sponsored plan in which the funds can be transferred, or should I say rolled over directly to you. In most cases, that's what a lot of custodians are doing. They're making the check payable to, say, for example, American Estate and Trust and your FBO, your name, and then they'll mail the check directly to you, in which you will then forward that check over to us. The reason being is that they want to make sure that that check, one, is received in a timely manner, because you have 60 days from the time that check is cut to get that over to a new custodian to ensure that there's not a taxable event. Anything 61 days and beyond, you're going to be subject to taxation and possibly an early distribution penalty of 10%. So it's really important that you understand the rules of the rollover and making sure that those funds are received by the new custodian within 60 days. The contribution is going to be relative to the type of plan that you're going to be choosing and or qualify for, and we'll talk about the different plans on the next slide. So what that is basically allowing you to take up to a certain dollar amount relative to what that plan allows out of your pocket on an annual basis and making a contribution to your plan. Now, one thing is really important, that this is where the relationship and the communication with your tax professional is for you to consult with them. All the plans that I'm going to mention on the next page is going to mention contribution limits up to. So what's going to happen is you're going to make sure that you have within those limits that you can make a contribution up to that maximum based on what's called your modified adjusted gross income. So don't go by the fact that you have a contribution, say $50,000 for a SEP IRA, and that's the maximum you can make, but not factoring in your modified adjusted gross income, because there is a penalty for an excess contribution of 6% of the amount that's contributed over the maximum allowable for that year, and that 6% penalty is applicable until that amount is removed. So if you carry that excessive contribution over to the following year, then you're going to be taxed another 6%. As long as that excess contribution remains in that plan and was never cured. So it's really important, once again, to converse with your tax professional. Conversions is the method of converting funds from a tax-deferred account to a Roth account. A lot of our clients are looking to convert monies from their tax-deferred accounts because tax uncertainty in our country is pretty much up in the air right now. So it's nothing worse than making a decent return on your investments only to find out in your retirement years you don't know where the tax rate's going to be. So that's another option, as well as getting monies from one account into the other and changing from a tax-deferred status to a tax-free status. So here are your different plans that can be self-directed, and here are the contribution limits for 2013. And once again, as I mentioned in the previous slide, these are contribution limits up to the maximum as mentioned on this, the slide in front of you here. Catch-up provisions apply if you're over the age of 50 and a half. So once again, you definitely want to consult with your tax professional and determine what your modified adjusted gross income. And this is something that you would have to do every year, because that modified adjusted gross income can change from year to year, and you don't want to be subject to the additional 6% penalty for making too much of a contribution to the plan. So the step to basically funding a loan investment, here are the quick steps. One of the things that's really important, because as mentioned in the IRS Code 4975, you're prohibited from going into a contract under your name and then switching it via an addendum or a contract. So it's really important that you establish your self-directed account in which you'll be assigned a legal account vesting for that IRA, and that is going to be the name that's going to be listed on any contract or documents as the quote-unquote lender or the investor. The next step is you're going to fund your account via the transfer, rollover, contribution, or a combination of all of the above to get the funds into your account. Step 3, you're going to complete some of our internal forms to authorize us to transfer funds from your retirement account over to the investment. And then once those forms are completed, depending on the structure of the investment, you're going to complete and provide a completed promissory note, deed of trust, if you're basically going to be making a loan directly out of your retirement account. If you're going to be investing in a fund, usually such as Red Tower Capital, their structure is usually that you're going to be completing some form of an operating or subscription agreement, which you're going to once again make sure that the investor or subscriber is going to be the legal vesting of the IRA. So once you've completed all 4 steps, usually within 3 business days of all these 4 steps being completed, the funds are usually transferred over to the investment of your choosing. So this is a flow chart in terms of what it would look like in terms of opening an account and funding it all the way to the point, getting the account funded up to the investment portion. So once again, fund the account, open the account. Usually you can actually have the account open within 24 hours, and it actually is short of a period of time of 35 minutes if you open the account online. Once again, you have different investment, or should I say funding options, would be a transfer, rollover, or contribution. It's important that you know what you're going to be investing in, as unlike some of your traditional custodians, we do not direct you towards any investment. We don't endorse any investment. So it's really important that you choose that investment and have also done the due diligence on the investment. We do not review or complete any third-party forms, so it's important that whoever you're going to be investing with, that they assist you with completing those third-party forms. If we can assist in terms of some of our information that needs to be conveyed in those forms, we'll assist there. But for the most part, if you're working with an organization such as Red Tower Capital, that's one of the areas that they will assist you in terms of completing their forms, such as the subscription or operating agreement. So once those steps, once again, are completed, you're ready to move forward and make your investment. In summary, IRAs can hold all types of investments, not just securities. Partnerships and split ownerships are allowed, which we did not cover today. IRAs and solo Ks, also known as a 401k, can grow tax-deferred or tax-free, and we're talking about, once again, the Roth as the option if you're looking to grow your retirement account tax-free. All plans qualify for both partial transfers as well as conversions. So if you're looking to convert funds from a tax-deferred account, you do have the option to convert a portion, not all, because I know that's a deterrent for some, that they don't want to pay taxes on the full amount to be converted. But you do have the option to convert a portion, and you're only going to be taxed on the portion that you convert. Be sure to establish and fund your account prior to entering into any type of investment contract, because once again, if we see any trace of the contract having been in your name prior and then transferred over to the IRA, we're going to reject it because of IRS rules as it relates to self-dealing. So that's pretty much my presentation for today. Here's my contact information. If you have any questions, feel free to reach me via telephone, email, and you can also reach me on any of the social media outlets listed below. In addition to information that we're covering today and on an ongoing basis, I'm always publishing information relative to real estate investing, retirement investing, and any other types of investment on these 3 sources when it comes to social media. So I'd like to thank everyone for joining us today, and we're going to go ahead and go over to the Q&A session, and which I'm going to go ahead and read off the questions as they have come in. And either myself will answer the questions relative to a self-directed IRA, and if it's relative to private lending, I'll go ahead and have Solomon answer those questions. Solomon, so looks like the first one is here. I guess you can answer or I can answer, and I'll just read off the question. How does one get started with no experience in this area of investment?
I guess 2 ideas, private loans or mortgage funds. If somebody's interested in a mortgage fund or even private lending, they might get some benefit from investing some amount with some reputable mortgage fund. If nothing else, that might be another reason to talk to those folks, the folks that are managing the fund like us or our competitors. And obviously relatively low risk, presuming that the folks that manage it know what they're doing. So that's obviously one step. Same step in if somebody wants to do individual deed of trust investing, for example, they can go ahead and talk to the folks that supply those types of loans, which generally speaking are mortgage brokers that specialize in private loans. Up until 2 years ago, for example, we brokered almost everything to individual investors, and that was a switch for us 2 years ago. We started working on our funds and using our own funds and other funds and putting them into our mortgage pool. So, I personally spent about 8 years just interacting with individual investors and essentially pitching them deals. The challenge with that is obvious, is that depends on who you run into. You need to start creating your own internal way of viewing the world, because some mortgage brokers, even who specialize in private loans, are better or worse at this than others. Some folks are trying to find you good loans and tell you the right thing, and some folks maybe are not quite as good as that. But yeah, certainly interviewing or potentially investing with some private loan brokers, again, who specialize in that, and then also maybe sponsors of mortgage pools if you're interested in that. Those would be my thoughts.
Okay, it looks like the next one is for you as well. Is my investment secure via deed of trust if I opt to invest outside of a mortgage pool or mortgage fund?
Right. So in a general sense, we don't offer a deed of trust, individual deed of trust anymore, as indicated in that previous few sentences there. So we used to do that. We would broker them out, and then in that case, and again in the case of other folks who are still doing that, there are other competitors. They're just smaller. Anyway, if somebody invests in a deed of trust directly, or half a deed of trust, or a whole deed of trust, or some other fraction, if they have the whole deed of trust, they'll actually have physical possession of the deed of trust. If they have half a deed of trust, or say a quarter of a deed of trust, I know this is not exactly the question, but I'm going to start here, then probably somebody else is actually physically holding that deed of trust, even though they actually partially own it.
Got it.
And just for a second on that, again, if we were the broker and brokered a deed of trust to, let's say, 4 investors in 4 equal parts, in a general sense, we would hold the physical note and the physical deed of trust on behalf of those 4 investors. By contrast, if one investor owned 60% and let's just say another investor owned 40%, if they had a written agreement or if either of those people were relatives of the other, probably they would own it, physically hold it rather, as opposed to us. In the case of a mortgage pool, the mortgage pool investors, let's say, we'll call it Red Tower Capital 2 LLC, which is what it is, or our competitor's version, the LLC itself owns all the deeds of trust, and the deeds of trust are all in the name of the LLC. And for example, let's say the mortgage fund has 100 investors or something like that, who might all have different investment amounts. They're all members of the LLC and own physical shares in the LLC, and just by quick extension, for example, they can fire the managers, let's say us. But in a general sense, the LLC owns the deeds of trust, and the sponsor sort of manages where are those deeds of trust physically located. Hope that wasn't too long of an answer.
No, it makes sense. And these are some good questions, because I know one of the apprehensions of some of the investors when it comes to owning a deed of trust directly or indirectly where they're investing in a pool is that they want to make sure if they go into a pool, what is the transparency? So my question to you before I go into the next question is, to the subscribers or the investors, what type of transparency do you offer in terms of, is there a list? Or I know one organization I work with out of El Dorado Hills, they offer a online portal for their investors to go onto a website to look at every property that actual pool owns, and to be able to, one, verify that their funds are actually being invested in these properties to prevent any type of fraud down the road.
No, it's a good question. I mean, with our Red Tower Capital 2, just started, so this is the end of our second distribution, which we're going to distribute in a few days. Just started at the beginning of the year, basically. Right now, we're thinking about that. Actually, one of the challenges, because Red Tower Capital 2, we like to disclose as much as we can. That's the first part. But one of the challenges with Tower Capital 2 is it's theoretically going to grow to having a really large number of investors who might have it's relatively small average balances. But the bigger issues, which we're delighted to involve, but the bigger issue is a relatively large number of investors. And the challenge is if let's say there's 100 or 50 or 1,000 investors in Red Tower Capital 2, 2 or 3 years from now, for example, if we give everybody the address of all the nodes, which in many ways sounds great, one of the minuses is that, let's say, 1 or 2 bad investor apples who might have relatively small investments and otherwise, strangely motivated, could try to potentially pick off our loans. They, in fact, might be a competitor in the marketplace of ours. Seems ridiculous. Frankly, I don't know of that having happened to anyone, but it's always been one of our basic concerns. For the bigger, just as an aside, so not to be the wrong, so we haven't closed the book on figuring that out. We do have online, we will have rather online access shortly for the account. Of course, we send everybody monthly statements. We invite them to come visit us here at our office if they like in downtown San Francisco, right next to Montgomery Station BART. It's pretty easy to come from pretty much anywhere. And we probably will have online access shortly as well. We just don't have it right now. But I would just slightly add just a little bit more that for the other larger funds that are separately managed, where we know the number of investors is 1, 2, or 3 people, and their obvious motivation is just to make sure their money's invested well, and of course the 2 or 3 persons are not worried about the other guy poaching the other loans, for example. Obviously they can have access to the complete files, and anytime we want, we generally speaking email them as we fund them, just so they're like, oh, this is what you're investing in. But somebody could come into our office and ask us to show them any of their files for RTC2.
Yeah, that's good to know, yeah. I want to do 2 more questions. These are also directed at you as well. In the event of foreclosure is necessary, who handles that, and what is the process, especially for those using self-directed plans? And one of the things that's important that I advise clients, even purchasing rental properties, to make sure you have reserves beyond the actual acquisition of the asset to basically service the asset, or basically to cover any unforeseen expenses coming down the road.
Yeah, you covered, I think, the most important issue, in my opinion, related to that question in self-directed IRAs. As you indicated, whether you own a house with your self-directed IRA, for example, or you own part or all of an individual deed of trust, like you explained, if you have expenses associated with rehabbing the house or paying the property taxes, and you don't have enough cash, I know I'm sticking with the house, in the account, the self-directed IRA account, you sort of have a little bit of a problem. So you always want to keep some cash there. But of course, what we focus mostly on is the private loans. But in the same way, for the individual deed of trust or fractional deed of trust owners, you really, under California law, if I'm not mistaken, I'm actually not an attorney, really the requirement on, this was something that was a problem with fraud in previous years, not recently, but the government created a rule on this, if I'm not mistaken. But anyway, basically the investor pays the cost of foreclosure. And of course, the related thing is they don't receive payments generally from the borrower during the foreclosure process for the obvious reason that the borrower is not paying, and that's one of the main reasons to foreclose. So in a general sense, if somebody has, for example, a $100,000 deed of trust that they're a whole or half owner, either it's, well, let's just stick with the whole thing. It's $100,000. Roughly speaking, it'll cost 1.5. It's a slightly high estimate, but it really depends on the loan amount also. There's a bunch of weird costs in there. So 1.5% of the principal balance. So if you have $100,000, you should make sure, you should expect if you have to foreclose, you need 50. Back to the borrower. So again, if you're an individual investor, you should deal with that. If you're managing your self-directed